Once a crown jewel of California real estate, San Francisco is now showing clear signs of a sharp decline. The tech exodus, sparked by remote work, high taxation, and surging crime, has dramatically reduced demand. Many major companies like Meta, Salesforce, and even smaller startups have downsized their Bay Area presence. As high-income workers leave for tax-friendly states like Texas or Nevada, the housing demand drops, especially in luxury and mid-tier markets. Vacancy rates in commercial buildings are hitting record highs, and that's bleeding into the residential sector. With fewer people working and living downtown, property values in once booming districts like Soma and Mission Bay are falling. Combined with high interest rates and falling investor interest, analysts project that San Francisco could see home prices decline by 15 to 20% in 2025 alone. For buyers, this looks like a window of opportunity. But for homeowners and investors? It's a ticking time bomb. And it's not just about numbers, sentiment has shifted. The dream of owning in San Francisco is fading, replaced by affordability concerns and quality of life issues. If trends continue, we may witness one of the largest urban housing price corrections in California's history. Fresno saw a major real estate boom during the pandemic. As people fled big cities, they sought affordability in the Central Valley and prices soared. But now, in 2025, the bubble is beginning to burst. Overbuilding, combined with weakening demand and rising unemployment, is pushing Fresno toward a painful correction. Developers rushed to meet the surge in demand during 2020 to 2022. Entire suburban communities popped up across the outskirts. But that demand was artificial, propped up by ultra-low interest rates and remote work policies. Now, those same homes sit unsold or are being flipped at a loss. Foreclosures are rising, especially among buyers who stretched beyond their means. Local industries, agriculture, logistics, and services are also facing economic headwinds. Water shortages, high fuel costs, and national inflation have weakened the Central Valley economy. With fewer jobs and reduced confidence, demand is evaporating. Some neighborhoods have already reported a 10 to 12% drop in median home prices compared to last year. Fresno's market was vulnerable from the start. Now that the tide is turning, it's becoming a warning sign for other inland California cities that overextended during the pandemic housing frenzy. Bakersfield has always been seen as one of California's last affordable frontiers. But in recent years, even this oil and agriculture-driven city has become overpriced. Fueled by pandemic migration and speculative buying, home prices in Bakersfield surged by over 40% between 2020 and 2023. In 2025, that growth is quickly reversing. The city's economy is highly sensitive to energy prices and agricultural performance. With oil demand fluctuating and environmental regulations tightening, layoffs in Kern County. Riverside County was once one of the hottest real estate zones in Southern California. Its mix of suburban lifestyle, affordability, and proximity to Los Angeles made it ideal for remote workers and first-time buyers. But in 2025, those very strengths are becoming liabilities. The boom in home sales during the pandemic led to a wave of overbuilding. New housing developments popped up everywhere, from Moreno Valley to Menifee. Now, as mortgage rates stay high and demand falls, builders are slashing prices and offering desperate incentives to attract buyers. The problem is compounded by rising living costs, stagnant wages, and high household debt. Many buyers who purchased at the peak are already struggling to meet their payments. Add in rising layoffs in warehousing and logistics, two major Riverside employers, and you have a downward spiral. Some communities in the Inland Empire are already reporting home price declines of 12 to 18%. Inventory is swelling, homes are sitting on the market for months, and price cuts are becoming the norm. Riverside's rapid rise has now made it one of the most overexposed housing markets in Southern California. Without a major economic boost or interest rate cuts, it's likely to remain in decline well into 2026. Sacramento, California's capital, experienced a major housing surge during the pandemic. State workers, tech remote employees, and Bay Area transplants flooded into the city, pushing prices to record highs. But in 2025, the cracks are starting to show, and fast. The city's economy is heavily tied to state government jobs, which offer stable but modest wages. As inflation and high interest rates eat into purchasing power, many local buyers can no longer afford homes priced for wealthier Bay Area newcomers. On top of that, the return-to-office movement is reducing demand from remote workers who once relocated to Sacramento for its affordability. Construction hasn't stopped either. New condos and subdivisions continue to hit the market, creating excess supply just as demand is drying up. That imbalance is forcing developers and sellers to drop prices significantly to stay competitive. Another red flag is the city's rising crime rate and declining school performance, which are pushing families to reconsider long-term residence in the region. Neighborhoods like Natomas and Elk Grove, once booming, are now experiencing growing inventory and price cuts of 10 to 15%. If the trend continues, Sacramento could see a significant price correction, possibly even a full-blown housing recession, by the end of 2025. For a city built on predictable government employment, the private market instability is revealing deep vulnerabilities in its housing foundation. Modesto, once hailed as an affordable refuge for Bay Area workers, is now facing the dark side of rapid growth. During the pandemic years, Modesto's home prices surged over 50% as families and investors flooded into the city. In 2025, that bubble is deflating, and fast. The local economy relies heavily on agriculture, retail, and warehousing, sectors hit hard by inflation, drought, and automation. As jobs dry up and wages stagnate, many homeowners are falling behind on mortgage payments. The result? A wave of listings, price drops, and early signs of a foreclosure spike. Complicating matters, Modesto's housing stock expanded aggressively between 2021 to 2023. Now, with less buyer activity and tighter lending standards, many properties sit unsold. Realtors report a sharp increase in price reductions, especially in the outer suburban communities that were once seen as hot investments. Adding pressure is the exodus of remote workers who are moving back to urban cores or out of state altogether. Without that external demand, the local market is forced to reset to a level that reflects local incomes, which are among the lowest in the state. Experts forecast that Modesto could experience a 15 to 20% price drop by mid-2025, with some areas faring even worse. For many homeowners, it's a rude awakening that the Central Valley's affordability was built on an unstable, short-term boom. Modesto, once hailed as an affordable refuge for Bay Area workers, is now facing the dark side of rapid growth. During the pandemic years, Modesto's home prices surged over 50% as families and investors flooded into the city. In 2025, that bubble is deflating, and fast. The local economy relies heavily on agriculture, retail, and warehousing, sectors hit hard by inflation, drought, and automation. As jobs dry up and wages stagnate, many homeowners are falling behind on mortgage payments. The result? A wave of listings, price drops, and early signs of a foreclosure spike. Complicating matters.